My son was probably about 5 or 6, and like a lot of 6-year-olds love Lego. Actually, he's 20 now, and he still loves Lego. But I remember looking at Lego, and it actually is a fascinating business model because they were this little Danish toy company we probably many of us remember as kids, and they started to take off in 2000. And the reason they took off is they started to develop kits that let kids or adults put together the Star Wars Death Star or something from Harry Potter. And suddenly they realized the value wasn't these little plastic bricks. It was, what would you do with them? How do you put them together to build stuff? And I remember walking into our president's office with a little Lego Harry Potter bust and trying to make this case. And thankfully, Mr. Capito did not throw me out. But I do think the industry's kind of followed a similar path, that it's not just the individual pieces, whether it's a passive ETF or an active ETF or a mutual fund. It's what can you do with them to deliver on a client objective? What can you build with them?
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome. This is episode 7 of The Bull of Wall Street. I'm Jim Worden, Chief Investment Officer for the Wealth Consulting Group. I'm joined by my co-host, Tally Leger, who's our Chief Market Strategist, and we're super, super happy to have Russ Koesterich from Blackrock join us. And so I just want to give a quick intro to you, Russ, and then I'll let you and Tally kind of take it from there. We've got a bunch of questions for you, but so you are the portfolio manager for the $50 billion global allocation franchise, the founder and lead portfolio manager for the global allocation select model portfolio franchise. You are with BlackRock. You are the global chief investment strategist, as well as the chief investment strategist for the iShares business and head and co-founder of the Model Portfolio Solutions business for BlackRock. Prior to BlackRock, you were the global head of investment strategy for scientific active equities at Barclays Global Investors, or BGI. And prior to that, you were the chief North American equity strategist for State Street Global. So that is like an amazing background, Russ. You can just maybe take us on a journey, and then we can turn over to Tally and we'll just go back and forth with some questions.
Yeah, no, thanks, Jim, and thank you so much for inviting me. I'm really excited to be on the show. Now, as you said, I've been with BlackRock now. It's going to be 20 years in a few months, and I came to them through BGI, which probably not a lot of listeners will remember anymore, but at the time, going back to the mid 2000s, it was actually the largest asset manager. And there was a quant shop, and I learned a ton when I was there. Really taught me a lot about portfolio construction and managing risks. So just it was a great background for all the things I've been fortunate enough to do since.
Russ, I don't know if you recall, but I'm just going to tell a little story here of how I know you. You may not remember, but I first saw you in the morning meeting at ISI when Ed Hyman asked you to come in. And I want to say this is probably a couple of decades ago now. So you were a client way back then. And then you remained a client when I was at Barclays on the sell side. And I don't know if you recall this, in 23, actually, we shared the stage. We actually spoke at the Sanctuary Conference for Marianne. Do you remember that?
I do remember that, actually. That was a lot of fun.
That was a lot of fun. I enjoyed it. We were competitors then because I was at Invesco, but now we're friends. I guess we're clients technically, right, Jim?
You are.
Yeah. It's a small world, I feel like, in the investment business. So I think, Russ, you and I may have met in San Francisco. This was years ago. And iShares was still kind of new, and then BlackRock bought iShares, and Brian Towns. I think you probably know Brian Towns.
You know, Brian. It's a long
Brian was a
time
great
ago.
guy, and I knew some of the other folks that were really into that scientific factor stuff. Mark Carver.
Yep.
I met with Andrew Ang when he was out in New York. So it's a small world. I feel like you keep staying in this business, you're going to keep bumping into people that or other connections, right?
Yeah, no, it's interesting. You have these people that migrate. I've been one of them, back and forth between San Francisco and the Bay Area in New York, and sometimes like myself back again. But it's good to talk to people that you've known for a long time.
So were you I remember iShares was a Barclays business at one time, right? Were you at that business when BlackRock purchased it and then you went over?
So I actually wasn't, but I was with Barclays. So at the time of the takeover, which was in 2009, I was leading the strategy and the business for our scientific active equities, which was our, basically was our quant equity business, which was pretty decent size, several $100 billion. And then about a year after BlackRock took us over is when I moved to the iShares business. And, part of the motivation for that was, at the time, iShares was just, look, we're going to sell a bunch of iShares. And if it was becoming apparent, you both remember this, the wealth business was starting to ask for, look, this is great. You've got all these different ETFs. Help me put them together. Help me build portfolios and think about, what I've got to do for my own clients. And that's when I joined iShares as the chief strategist to sort of lead that effort. And that actually grew into the model portfolio business, which ultimately began within iShares in 2010.
Right. Well, I own personally IJH, so mid caps are a long-term core holding of mine. But we're rooting for you. Let's go, BlackRock.
Thank you.
So, Russ, when you were first at BlackRock, when iShares was kind of new, and maybe I'm wrong, but it feels like there was a lot of money with BGI that was all institutional. ETFs were still fairly new. It feels like maybe that's kind of flipped. There's a lot of money. You guys are managing trillions of dollars in ETF. How has that changed, over time? And what do you think is going to happen like going forward? Are we going to get more and more in ETFs? And now we're starting to see more actively managed ETFs. And I know you run some of these strategies that are more active, particularly the Malox fund. But what do you think?
No, I think it's fascinating because you're exactly right. When I was at BGI, there were two parts to it. There was the institutional business, which I was a part of, and there was iShares, which was much more geared at the wealth market. And I won't say there was a Chinese wall between us, but there was not that much interaction. You manage institutional money, or you were focused on iShares. And I think, to BlackRock's credit, that did start to break down after the takeover. And, one of the things that definitely we realized is I joined iShares, and more people from the institutional business start to move over, and more people with an investment background, was that one, there are other things you can do within the ETF wrapper. And as you point out, Jim, that eventually grew into active ETFs, which is where a lot of the growth is now. But I think the other thing that really changed was the notion of model portfolios, that iShares was no longer just a business where you're selling individual exchange traded funds, but there was a lot of demand, and I think it's only grown in the last 10 or 15 years to think about how do you put those together. I remember at the time, my son was probably about 5 or 6, and like a lot of 6-year-olds love Lego. Actually, he's 20 now, and he still loves Lego. But I remember looking at Lego, and it actually is a fascinating business model because they were this little Danish toy company we probably many of us remember as kids, and they started to take off in 2000. And the reason they took off is they started to develop kits that let kids or adults put together the Star Wars Death Star or something from Harry Potter. And suddenly they realized the value wasn't these little plastic bricks. It was, what would you do with them? How do you put them together to build stuff? And I remember walking into our president's office with a little Lego Harry Potter bust and trying to make this case. And thankfully, Mr. Capito did not throw me out. But I do think the industry's kind of followed a similar path, that it's not just the individual pieces, whether it's a passive ETF or an active ETF or a mutual fund. It's what can you do with them to deliver on a client objective? What can you build with that?
Super fascinating.
So talking about that business, we're jumping around a bit here, but that's okay. I'm thinking about this in terms of decades, not recent years, but you've been at Blackrock as long as I've been in the business, pretty much. But maybe you can help me kind of sort it out. How do you kind of fit into the organization there relative to some of the newer personalities like Gargi and Wei Li? I've met Gargi, actually presented for her, but I have not met Wei Li. Maybe we'll have one of them on the show.
Yeah,
that would be great. They're both great presenters and great investors. So I actually, so Gargi is now the lead strategist for iShares, which was a job I had back in 2010, and Wei is the chief global strategist for our Blackrock Investment Institute, which I had that role between 2012 and 2016. So really, a little bit of a different focus. I mean, Gargi is very focused, I think, on this question of how do you put the pieces together? Whether that's, all passive portfolios, active, passive, bringing the thinking of the firm together, particularly as it applies to that part of the business. Way within our BlackRock Investment Institute, and there are a number of other large firms that have similar think tanks. But the way we've approached it at BlackRock, we've assembled, and credit to Larry Fink and the rest of the management team, this unbelievable team of people, from Tom Donaldson, who is the chair of that. He was President Obama's national security advisor. Jean Boivin, who's the lead researcher, who spent many years with senior positions in central banks. And the goal is to have a number of people with deep backgrounds in policy, in economics, in politics, and then to have that be a center of critical mass where all of the investors within the firm, we get together a couple times a year, we debate our views, we debate our positioning. And while all the teams in BlackRock do have their own investment views and ways of looking at the market, to try to see where there are commonalities, to try to see where we can come together as BlackRock and really try to present a bit of a firm view. And Wei really runs that process. She kind of corrals us twice a year. They lock us up in a conference room in New York for about 36 hours. And we debate, we argue, we discuss. And then, her role is really to bring that all together to something coherent at the end of that. And she does, an absolutely brilliant job in leading that effort.
Wow. I can only imagine. I would love to be a fly on the wall on one of your meetings. It sounds kind of like the PIMCO meetings where they lock themselves in the room with Ben Bernanke.
Probably very similar. I've never got to go into that inner sanctum, but I imagine it's pretty similar.
Yeah. So as you mentioned, you got this really deep bench. I see that you've got Kate Moore on your team, who's thematic. Randy Berkowitz is quant. You have Sarah Thompson there that is over fundamental.
Kate's leaving,
I guess
though,
that would be kind of like the CFA stuff. And then you're working really as a co-portfolio manager with Rick Reeder. So how does that work if you both love, like if you love equities and he loves bonds? I mean, do you have like an arm wrestle, or like how does that work? How do you flesh out that and just tell us kind of about the Maalox story? By the way, your global allocation fund is performed really, really well when you compare it to all these other global allocation strategies that are out there. So what's the secret?
Yeah, no, thanks, Jim. And this is a really, for those who might remember this fund goes back now 35 years. It was started, back, I was in school at the time, by two gentlemen, Dennis Statman, who ran the fund through 2017, and Brian Eisen, who was his co-portfolio manager through 2000. And it really came out of the 87 crash, which probably is distant history for a lot of people right now. But It was designed to basically be the all-singing, all-dancing multi-asset fund. That this was a ticker You could put your clients into the long term. It had a very strong downside protection mandate, deliver equity returns with less volatility. And thankfully, I think it's delivered on that over a very long period. You sort of alluded to, Rick and I come from opposite ends of the business. Rick is the bond guy. I'm an equity guy, but I think we've definitely met in the middle as multi-asset investors. And, we're fortunate not only to have a very large bench. You mentioned Randy, Sarah, we've got a team of about 55 investment professionals. But what's really helped over the last 5 or 6 years is, Rick in his role as the CIO for fundamental fixed income brings another 450 people on top of that, which are analysts with macro backgrounds, credit backgrounds, rate backgrounds, literally all over the world. So, really, I think my job and Rick's job is to think about how do you bring all of those resources together, one, to build an asset allocation framework, and two, to fill in the pieces underneath. And, when you ask about the secret sauce of Global Al, I think one of the things that's very unique is that when we have this very strong macro focus, and Rick and I, we do a PM meeting every week, we bring in all the senior investors. It's also a bottom-up fund. And when we talk about our equity allocation, we're not just allocating to U.S. equities. We have very specific names that we like, and the same in Europe, Taiwan and in Latin America. And what that's enabled us to do over the years is, look, a great example right now is Europe. There are names in Europe that we think are great long-term holdings. Semiconductor companies in the Netherlands. European banks are still cheap. European luxury good companies. But we don't want to own everything in Europe. But the fact that we have this large team of fundamental analysts, both on the equity side, credit side, means that you can own the names you want. And the performance of the fund in any given year is going to be as much a function of our bottom-up security selection as it will be on the big macro calls that we're also going to have to make.
Wow. Yeah, I mean, 400. I can only imagine 470 analysts total. I mean, that's pretty incredible that you have that. So if you've got all of these resources, and you invest in private markets too, right? So you're in private credit. There's some private equity, or I don't know, late stage venture maybe.
Wow.
Yep.
If you can go anywhere, really, what is exciting to you right now? What do you worry about?
So, let's start with what we're worried about. I think there are a couple things. Obviously, what dislocated the market in December, we didn't get our normal Santa Claus rally, was arguably largely in the rate market. And this is an ongoing concern. It's something we didn't have to worry about for a long time. Before 2022, we lived in this world where the inflation prints were yawn, and if anything, the Fed couldn't get inflation to their target from the downside. And obviously now we're in a different world where inflation will has come down quite a bit. Credit, to the Federal Reserve for navigating this. The last mile is proving tough. And if you have a world where inflation is stuck, core inflation at 3.1, then similar to 2024, the first question I've got is, are we going to get as many rate cuts as the market has discounted? Now, the good news is, the market has gotten much more realistic in its expectations. But still, there are legitimate questions about what are we going to see in terms of the Fed. Second issue, I think, is tariffs. The market's got a little bit of euphoria today because the belief is they may not be as punitive as maybe some are concerned about, but certainly a very aggressive tariff regime can dislocate the global economy. It will have impact on inflation in the near term, and that's another concern. And then finally, I think this is a year we are very much of the view that many of the secular growth themes, not just AI, but internet commerce, social media, some of the developments we're seeing on healthcare, these are long-term durable trends. We like these. We're overweight many of the names. But there's one thing that I do think we have to watch this year, which is one of the reasons, many of the Mag 7 and the mega cap tech names have done so well. They're cash flow machines. They generate ungodly amounts of free cash flow. That becomes a question mark in an environment where they're also going to be spending tens and maybe hundreds of billions of dollars. on CapEx to develop this next generation of tools. So I do think we're going to be in a year when investors are going to want to see that many of the companies that have led the market over the past 24 months can continue to generate free cash flow when they're also investing so aggressively to build out, the next generation of large language models and hyperscalers and all the other really infrastructure that the knowledge economy is going to require to keep going.
Hey, Jim, let me just jump in here with a question.
Yeah, go for it.
So I appreciate the macro themes and, the thoughtful kind of walk through the risks and concerns. I'm just going to kind of rewind the tape a bit. And this goes back to the panel we spoke at. And it was early 23. And I delivered my 5 reasons why I thought the October 22 lows would hold. And it was wildly unpopular and controversial view, but we never looked back. So two years hence, here we are. And my number one reason at that time was peak fear. So what do you think has changed since then? Do we still have fear in the marketplace, or maybe there's too much bullishness? Where do you stand on that view?
Well, Tyler, I remember you had a great call, and history is proving you exactly right. I think this is a legitimate question because, in 22, and I'm trying to think back, obviously there were still these lingering concerns about, are we going back to the 70s? Are we going back to stagflation? And I think those fears have generally dissipated. People are also concerned not only in October of 22, but as you'll remember, probably for a lot of last year, and certainly in 23, we're going to get a recession.
Yeah.
And, the Journal and other, financial periodicals were pointing out what the yield curve was doing. And everyone was going back to, well, when the yield curve does this, you get a recession. And it didn't happen. And,
right.
And I think there were good reasons it didn't happen. And I'm actually not worried about a recession this year. But I do think your point about, if we had peak fear in 22, do we have peak optimism today?
Yeah.
Maybe. Certainly you've got the market trading at 22 times forward estimates. That's not cheap. And I can give you some reasons why it should be elevated, but that's still a hard valuation to back into. It is a very narrow market, as you know. Matter of fact, if we look at December, the number of stocks beating the market was the lowest going back more than 30 years. So we find ourselves in an expensive market, a market where maybe rates are not going to be a tailwind, where breadth is very narrow, and you've got a handful of mega cap companies that really need to deliver. So I do think that if there was a lot of fear in the market in 22, maybe there's not quite enough today, which means we're probably going to get some bumps along the road this year. And even if stocks continue to gain, I doubt it's going to be a straight path forward.
Yeah. Well, as you know, Jim Warden's a CMT, a technician, amongst other things. But the poor technical humor I like to use to get him to smile is we say bad breath in the market. But the way I'm thinking about this, and maybe we're all kind of looking at the same things, but tactically, a lot of the positioning and sentiment surveys, they're telling us there's probably a little bit too much bullishness out there for equities. Positioning is lopsided. But that to me is very short term, right? Longer term, we've got a mountain of cash on the sidelines. That smells of fear to me, structural fear. So I think that's why Jim and I come down long term, as we think this bull has some room to run.
I would agree with that. And I think that cash is really the dry powder that keeps you going. And not only do you have that cash, and again, there are different estimates, but you're talking north of $5 trillion. People are going to start getting less on that cash.
Yeah.
And it's already been happening. That is, in my opinion, and I know Rick has been very vocal about this in various venues, that's going to drive more allocations, probably both on credit. Spreads can continue to grind a bit tighter, keeping equities elevated. So I do think that while it's probably not going to be another 25% year, I think it's also a year where we're going to get some drawdowns. I think we're going to end the year higher. And I would definitely agree with you that cash pile is part of the tailwind that pushes us forward.
Yeah.
So I heard Rick speak on another podcast not that long ago, And he said something that was a little bit surprising. It was a bit more bullish, coming from a bond guy, a little bit more bullish than I would think. But he was saying that because of how much of our economy is driven by services, not so much manufacturing, and because of how the Fed just gets involved with stimuli after stimuli, we may not have the same recessions that we've had in the past, like the last couple recessions that, not looking at the pandemic, but global financial crisis was clearly financial issues. You had valuation issues back in 2000. But what are your thoughts on that?
No, I think that's exactly right. And I should say, Rick is the most optimistic bond guy you're ever going to be.
He is
a good multi-asset class investor. No, look, it is a different economy, and there are a couple things. You've had this massive shift from goods to services, and we were joking last summer it was Taylor Swift's economy, and not just because you couldn't get tickets to her concerts, but it was very indicative. It was a great example of how spending patterns have changed, how services experience have just garnered market share, garnered wallet share relative to 30, 40 years ago, and it's also meant the market is so different. You think about the Fed had this huge tightening cycle. Why didn't we get a recession? Well, part of the reason is that the companies that dominate the index, their balance sheets look so different than the comparison from 40 years ago. 40 years ago, I wasn't around the market, but you think about companies like GE or Exxon or large retailers. They had a mountain of debt. They had to spend billions of dollars every year in capital spending. If the Fed jacked up rates, it cost them lots of money, and it affected their hiring, their capital spending, all of their plans. So you think about the last couple of years, who are the dominant companies? Microsoft, Apple, NVIDIA, Meta. They've got somewhere over $600 billion of cash sitting on their books and virtually no debt. So if we see the Fed jacking up rates, yes, it's affecting certain segments of the economy. Yes, it's affecting lower-end consumers. For these mega cap companies that dominate the index, all you did is drive up their interest income by several $billion.
That's right. Well, so
and we've kind of talked about that as like a fast-moving train. This, like the AI companies, like it doesn't matter whether 10 years at 5 or 4 or 3, they're going to keep going. But what about the companies that are smaller? At what point does it start hurting some of those?
I think it already has.
Yeah.
I mean, this is why, how many times do we get, now is the time for small caps, now is the time for small caps. And at some point, that's going to be right. Although, I point out, and I'd love to hear both of your views on this. Generally the small caps, it's an environment of increasing nominal growth coming out of a recession. I think one of the challenges we've had with small caps is going back to the question about rates. There's a lot of rate beta that segment of the market. And, small caps popped in July, they popped after the election. But when you get the optimism of the economy starts to show up in higher rates, those rallies don't last. And, this is one reason I think it was Tally that mentioned earlier the mid-cap position. We very much agree with that. But we've been cautious on small caps because of that rate exposure, which is the exact opposite of what we're seeing with the mega caps.
Hey, Jim, let me just jump in here because Russ was making a pretty interesting philosophical point. And we were talking earlier about why, and that's the big question, right? Why didn't we get a recession when we should have? All the classical traditional indicators were screaming recession. But I think what you're really saying, Russ, is that it seems that the monetary policy transmission mechanism was broken. And you talked about the businesses, rightly so. A lot of those companies issued really low cost debt around the lows when rates were there at rock bottom levels, but so did consumers, right? The lion's share of the economy. And in fact, you can look at this, the weighted average outstanding mortgage rate is 4%. So, that's why it's pretty simple, where the financing has been, and I experienced that myself, and that's just anecdotal, but I know exactly it frees up all this extra cash flow and we prepared for a recession that never happened. And now we've got operating leverage,
Yep. I think that's exactly right. I mean, companies, as you point out, households, they refinance at the lows. So you've got a lot of people sitting on those low mortgages. You've got a significant portion of the homeowners, pretty older, more affluent homeowners that actually don't have a mortgage. So that transmission mechanism, it's not having the same impact. Now, yes, if you're talking about that bottom quintile of households, it's very much an issue.
Yep.
We've seen that come up with rising credit card delinquencies, changes in buying habits and dining out from lower income consumers. But many of the more affluent consumers that drive much of the spending, just like Apple and Microsoft sitting on cash, now getting rewarded for that. That same dynamic is playing out at the household level as well. And then you put on top of that, a good housing market, a booming stock market, people are spending.
Yeah. Well, we were rooting for the Santa rally. We did our best, but you can't have it all, right? It was still a great year, so we're not going to complain.
Well, today is a good day, and I looked at all the data for Santa rallies, and I mean it's a little bit hit or miss, right? So I don't want to put too much weight in there, but Russ, so looking 2025, maybe looking like not just 2025, but the next few years, what are you seeing that excites you the most? Maybe it's a trend, maybe it's a valuation. You mentioned AI. I don't know if productivity kind of falls in there too, because like that could be something that drives inflation lower. But maybe some of these other areas that are less liquid, there seems to be a lot of money that's gone into private credit, private real estate, private equity. What excites you the most?
And I think the opportunities in credit are still interesting. Clearly not as generous as it was, but still a great opportunity to go out there and build a decent portfolio. I do think that the AI theme, we're going to get some bumps in the road. You're going to get hit 20% on a given month, but it's still a long-term theme. And exactly your question, what would I like to do over the next 2 or 3 years? I'm going to continue to buy that on weakness. And then the final one is something that hasn't been working, but I think at some point will turn around as healthcare. There's been these huge innovations we've seen in new drugs, GLP, and healthcare has been a big underperformer last year in particular. And I think part of that is the market we're in. The economy's booming. People are excited about deregulation. They're nervous about what happens with drug pricing. But I do continue to think that healthcare is going to be an area of long-term growth.
So that's
interesting. Well, I wonder what healthcare would have done if we removed Eli Lilly, Novo Nordisk, and because those have done really, really well. It probably would be a lot more challenging of an environment.
Absolutely. But I think some of those names, again, you're always subject to the latest drug tests, but, these are some pretty significant innovations. And if you think what's happening with, customized medicine, using technologies like mRNA, which really gave us, COVID vaccines in record time, and how that might be applied to cancer treatment, there's some really exciting things going on right now.
Jimmy Lee, our CEO, who couldn't join us, but he asked us last week. We have these investment strategy committee meetings every week, but he asked us about healthcare last week. Now, I want to kind of go back. If we were sitting back at the end of 23, looking ahead to 24, the setup for healthcare was pretty similar. The earnings expectations were supposed to be fantastic, and that was true at the time, but it didn't seem to matter for the stock prices. So what's like, help us out. What's different? Because it's the same setup. What's different for healthcare this year? What's the catalyst to unlock the valuations? Do we need a recession for that defensive sector to start working?
I think you nailed it. And it's not that the setup is that different, which is why I don't think you have to rush to buy these names, because if you do this environment where people are very focused on the strong economy and potential deregulation beneficiaries, which are probably financials, healthcare may not perform in the first quarter. I do think that you hit on something very important, which is that, apart from the fundamentals, what is the market environment? What are investors looking for? And it may take a little bit of a slowdown where you start to get some more modest expectations about the economy. People aren't quite as bullish about the cyclicals, for them to look at some of these names in the more defensive parts of the market, including healthcare, that are likely to do well even if the economy does moderate. So that might be a second half of the year opportunity. But I think for investors that have a 3 to 5 year time frame, you start to look for chances to add to the positions.
Interesting. So, Russ, I have to ask you about Bitcoin, because Blackrock and a number of other firms rolled out these Bitcoin products. And I honestly thought, like a few years ago, like, this will never happen. We're never going to see Bitcoin. But then we end up getting like futures for Bitcoin, and like, there's just so much demand. And, I was probably very late to the game, like some folks, to buy into Bitcoin. So I own some. It's done well, but in hindsight, I should have bought it, of course, years ago. You guys own it. You also own gold and the Maalox fund. But like, can you talk to that? I mean, what do you think? Because I feel like for a long time, and even Jamie Dimon was like, this is never going to be a thing, Bitcoin, but here we are.
Yeah.
And it feels like it is. And then where do we go from here?
Yeah, no, I'll have to admit, I was a skeptic for a long time, and I get it. I mean, it's a harder asset class to wrap your arms around, but I think there is an answer, and actually, it's the same answer I'd give for gold. And we do have, around a 2% position, maybe a little more in global allocation in gold. And that is the store of value argument.
Right.
The notion that, one of the things we haven't spoken about yet, because I don't think it's the threat this year, but certainly if you're talking 5 to 10 years out, you have to think about it, is just the unsustainable fiscal path. We've got deficits in the U.S. that we've never seen outside of recession or war. Debt is going back to levels that we only witnessed in the aftermath of the Second World War. We're not the only country that is struggling with significant fiscal challenges. And you have to worry, well, long-term, how do you get out of that? And obviously, there have been various ways governments have done it throughout history, whether it's monetizing the debt, printing money. Hopefully it doesn't come to that. But, these are risks that people are thinking about. And I think the attractiveness of gold and Bitcoin and other potential cryptocurrencies is that, Bitcoin in particular, is you've got limited supply. You can't just print an unlimited amount of these assets. And this is something that investors are looking for. What can I own that is going to hold its value over the long term? It's going to hold its value if we do see a precipitous decline of the dollar, maybe not this year or next, but over the next 10 or 20 years. And what are those long-term hedges? And I think there are a couple reasons, Bitcoin, enjoyed the success the last year. One, foreign central banks are also worried about the dollar, albeit for different reasons. Some of them just want to de-dollarize their holdings, and gold is certainly one of the ways to do that. Some of them are worried about sanctions, which is another motivation for holding less dollars. And you're getting to this world where, again, I don't think there's any risk to the dollar in the short term. But whether it's foreign central banks that want to hold fewer dollars for political reasons, or individuals that are understandably worried about what is the U.S. Currency going to look like in 20 years, we keep racking up these debts. I think this is why you saw the rip in gold, the rip in Bitcoin over the past year.
Whether we like it or not, I think everyone's going to be an owner of Bitcoin, because that company, MicroStrategy, that's been using all its cash, the software company, to buy Bitcoin, it's getting added to the NASDAQ 100. So yeah, it's a thing. It's ubiquitous.
That's wild. Russ, do you guys ever look at things like quantum? I feel like that seems like people are starting to look at it a little bit more. I mean, it's still kind of early, it's still new, but I don't know. Is that something you guys look at?
We have not, but I think with a lot of these, you're going to see a broadening out it won't stop at Bitcoin. Again, I think one of the reasons Bitcoin has enjoyed the success it has is because of the way it's structured and the limitations on supply. But it's not to say there can be other ways to represent those themes. And again, it goes beyond sort of cryptos or commodities. What else can you own that just is going to have some restraint on the supply of that asset? I think that's going to be a big theme, particularly if you're of the view, and I certainly am, that we don't necessarily see the fiscal situation improving anytime soon.
Super fascinating. Do you and Rick ever talk about like the US dollar and like not anytime soon, but like way down the road? Does this ever become a concern? Like it's not the reserve currency. I was at PIMCO like, I don't know, like a year ago, and the PM was kind of like pounding the table. This will never be an issue in my lifetime, but maybe, down the road it becomes an issue. Do you guys ever have discussions like that?
We do. And again, I would agree to a point. I do think if you're talking about, call it the next 5 or 10 years, I do not worry about the U.S. currency losing its reserve status for a simple reason. What replaces it? We've all can remember the discussions, 10 years ago, it was going to be the RMB. But China's never, fully loosened their capital restrictions. If anything, they've got a bit tighter. And there are all sorts of regulatory and political issues no one was worried about 10 years ago that now would keep many investors to remain light on China assets. And then if you go back 15, 20 years, it was going to be the euro. And then we had the euro crisis, and that kind of disavowed everybody of the euro being a slam dunk. So I do think that, despite all the problems with the dollar, look, the U.S. is still the strongest developed economy. It is still the epicenter of most of the innovation we're seeing in many of the industries we've been talking about. So if you're talking about 10 years, I would continue to believe the dollar is going to maintain reserve status. Now, at some point, there are questions about the U.S. fiscal trajectory. Crypto probably will continue to gain acceptance as investors that grew up with it are not going to have some of the concerns perhaps that an older generation of investors have. So 25, 30 years out, I'm less confident. But I think under the horizon, most of us are talking about, today, which is 5 or 10 years. Yes, I think the dollar still maintains its reserve status.
And what about this DOGE, the Department of Government Efficiency? Is that going to rein in some of the spending, or is that something that you don't really see having any significant impact anytime soon?
Look, I think this is a wild card. And actually, I don't dismiss it. I mean, you have a person that has a credible claim to being the smartest human on the planet, and someone who clearly is not afraid to break things in delivering on a goal that's made it now his personal mission to improve government efficiency. I don't know, that could actually have some surprising results. I think that there are a lot of areas. We all know government waste is rife. Certainly, there are many, many things you could do to improve it. But here's the big question that I think everyone is aware of. When you talk about some of the targets that have been thrown around, and I think we've heard we're going to cut $2 trillion of government spending. Well, the government spends $2 trillion of government spending. Government spends $6.75 trillion a year. 72% of that is in entitlements and interest payments. And of the remaining 28%, roughly half is in defense spending. So assuming that, you can't do anything about interest spending because I don't believe we'll default on our debt, and defense spending is likely to go up, not down. If you're going to get massive savings, it's mathematically impossible to do that without making some adjustments to the entitlement program, Medicare, Medicaid, Social Security. So then the question is, are those on the table? And I think the truth is right now, we don't know. Certainly, President Trump did not run on a platform of changing those, but it's certainly, you can see some evolution in thinking that leads to results that are unexpected. But if we're going to see those big numbers that really reduce the supply of treasuries that the government has to sell, reduce the pressure on interest rates, maybe eventually on the dollar, then the question becomes, are entitlements going to be on the table or not?
We had a
Seems like they always kick the can on that one. Yeah, go ahead, Tally.
Yeah. I'll just jump in here. Not necessarily a question, but just some comments. We had a guest on, Libby Cantrell from PIMCO. I asked her that very question, but she reminded us that Musk is not technically a government employee. He's a private citizen. So the reality is that the DOGE is pretty limited in terms of what it's going to actually be able to accomplish. So and I'm thinking of the dark scenario where, hey, what if the Doge is wildly successful? Is that going to amount to fiscal austerity and spending restraint? And I think the answer is probably not at this stage.
Mm-hmm.
Yeah, no, you're right. It could both ways. And she raises a very fair point. And I think the assumption, which for now is valid, is that, whether a private citizen or not, clearly Elon has got a very close proximity to the president-elect. Yeah. And if he can make a case, and, that could become a policy fairly quickly. But, again, what's the remit? How far are they willing to go? And, what is or is not off the table?
But your comments about the dollar, insofar as it can weaken, are most welcome, because to me that would help remove a headwind to that that foreign component of U.S. multinational sales. So, and right now it's a bit of a concern. That's one of my kind of risks for the year, I think.
I think that's fair. And we were talking about rates before. It's that tightening of financial conditions, to the extent that, the Fed maybe cuts once or twice, but if you've got, rising real rates, you've got a stronger dollar, and financial conditions at the margin are getting tighter. Again, if earnings are strong enough, maybe you get away with it, but generally that's going to be an environment where I think it becomes harder to maintain these premium valuations that we've built up over the last, 24 or so months.
You make a great point about financial conditions, and at least conceptually, the way I was just thinking about this over the weekend, but the tightness there, and you point them out correctly, is coming from the higher rates and the strength of the dollar. But the offset on the other side, and this is why it's kind of a mixed picture, thankfully, I think, because you're not seeing a wholesale, I think, tightening in those conditions, because stock prices are still strong, and so is credit. So those are the key offsets there. What do you think?
I think that's totally fair. You've seen a very liquid credit market. The equity market obviously kept powering forward, and this is why measures like the Goldman Sachs Financial Conditions Index, which a lot of people watch, generally have been indicating looser conditions, a little bit of a switch in direction in December. The other thing which, could be a big help, which we haven't spoken about right now, is deregulation on the financial side. And this is something that I do think we're likely to see. Doesn't require congressional approval. A lot of things can be done from the administration. And if we do see an evolution of the regulatory environment, and it does lead to better credit conditions, this is a tailwind. And that's something that, could kick in and offset some of these other factors we've been talking about.
That's a great point.
So, Russ, I know you got a hard stop here, but I really just have one more question about housing. I don't know what your thoughts are housing, like the housing market. As Tally mentioned, a lot of people refinance. This was fantastic for a lot of people. It's a really, really good thing. There's a certain demographic. This is really a bad thing. You could be someone just getting out of college, getting your first job. It is almost impossible to buy a home unless you're making a lot of money. And I don't know. I wonder that like the only thing that kind of resets this, gets this back to normal, is rates coming down enough to where people do refinance and you get a little bit more supply that comes out from existing homeowners. Right now, it looks like the existing homeowners don't want to sell because they're saying, why would I sell? yeah, I don't know. And then the home builders, they're not building enough. And so what are you guys thinking about kind of this dilemma, this dynamic with housing and where do we go from here?
Well, Jim, I mean, you framed it really well. I mean, it is a paradox because on the one hand, we've got, record low or close to it affordability. And then we've got a strong housing market. And part of it is for all the reasons you mentioned, supply is limited. We're not building enough homes. The people that are in homes either don't want to sell or they're afraid they're going to have to go pay more for the next home and they don't want to lose their mortgage. So you had this very low velocity. How do you get out of this? I think there are three ways. One short-term, one long-term, and one that's more geographic, more specific. So, as you point out, mortgage rates are 7 or above. That's not helping. If we do see the Fed has the latitude to cut, that will provide some relief. Mm-hmm. But long-term, it's got to be supply-led. We have a significant shortage of housing in the country, a significant shortage of affordable housing. The only way you're going to bring home prices down significantly, and exactly as you say, give people just trying to get up on that housing ladder, young couples, young households, a chance to own that first home is going to be supply. Now, there is a dynamic going on that I think makes this a little bit more palatable, which is the shift in geographic distribution. And we all know what's happening. It's been going on since before the pandemic. It's accelerated. California, Illinois, New York, New Jersey, losing significant number of individuals each year. Where are they going? They're going to Texas, they're going to Florida, they're going to Tennessee, they're going to Arizona. Now, there are many things that recommend those places. The weather's good. Many of them are low or no tax states. But one of the big themes is affordable housing. And I think this is something that helps reconcile this paradox. And if you're going to continue to have an affordability problem in New York, in California, well, you're going to continue to see migration to all of those southern and Midwestern states. And, it's pretty fascinating. I was talking to a friend about this. I see it in my own travel. The number of times I've been in Scottsdale or Nashville in the last year is more than I've been to New York or San Francisco.
Interesting.
That was not the case 10 years ago. But, if I'm seeing clients, more and more of them, I'm seeing it in some of the places we just spoke about that are benefiting from more affordable housing and are likely to continue to do so.
Russ, we really, really appreciate your time here today on the Bull of Wall Street. Hope you have a wonderful new year.
Come and dance on our floor.